Hi, my name is Catherine Jarrett, and I would like to discuss measuring risk. Risk management is a crucial process that is used to make investment decisions. Some common measures of risk are standard deviation, beta, and VAR. Standard deviation measures the dispersion of data from its expected value. The standard deviation is used in making an investment decision to measure the amount of historical volatility or risk associated with an investment relative to its annual rate of return. It indicates how much the current return is deviating from its expected historical normal returns. For example, a stock that has a high standard deviation experiences higher volatility, and therefore a higher level of risk is associated with that stock. Beta measures the amount of systematic risk a security has relative to the whole market. The market has a beta of 1, and it can be used to gauge the risk of a security. If a security's beta is equal to 1, then the security's price moves in time step with the market. A security with a beta greater than 1 indicates that it is more volatile than the market. Conversely, if a security's beta is less than 1, it indicates that the security is less volatile than the market. For example, suppose the security's beta is 1.5. In theory, the security is 50% more volatile than the market. VAR, which stands for value at risk, is a statistical measure used to assess the level of risk associated with a portfolio or company. The VAR measures the maximum potential loss with a degree of confidence for a specific period. For example, suppose a portfolio of investments has a 1-year 10% VAR of $5 million. Therefore, the portfolio has a 10% chance of losing more than $5 million over a 1-year period. A market portfolio is a theoretical bundle of investments that includes every type of assets available in the world financial market, with each asset weighted in proportion to its total presence in the market. The expected return of a market portfolio is identical to the expected return of the market as a whole. So now we want to talk about the market proxy. What is a market proxy? A market proxy is a variable that theoretically simulates the behavior of the overall market. And how does it work? Well, analysts and investors use market proxies as part of statistical analysis and portfolio modeling. Analysts and investors also use market proxies as benchmarks for comparing the performance of a stock to that of the market. And why does it matter? It matters because a market proxy is a purely theoretical representation, and it cannot fully reflect the entire range of price movements for all market sectors. So that's something that you need to know. Now let's discuss the Dow Jones Industrial Average. The Dow Jones Industrial Average, what is that? It's typically called the DJIA, and it is a price-weighted average of 30 significant stocks traded on the New York Stock Exchange and the National Association of Security Dealers Automated Quotations, called the NASDAQ. The Standard & Poor's 500 index, or the S&P 500, is an index of 500 stocks seen as a leading indicator of U.S. equities and a reflection of the performance of the large cap universe. It's made up of companies selected by economists. The S&P 500 is a market value weighted index and one of the common benchmarks for the U.S. stock market, so it's very important to understand that. Lastly, let's talk about the ethical issues that are related to measuring risk. The main issue that I foresee with ethics as it relates to measuring risk is in the stock market itself, specifically as it relates to short selling. Short sellers what they do is they first sell at a high price, and then later they buy the stock back at a lower price. Sounds like falsification to me. Anyway, they sell stock initially that they do not own. This is a common strategy that nearly any brokerage account may utilize, but it is characterized with a negative stigma. After all, short sellers are making money while other investors watch their portfolios dwindle. Part of the ethical dilemma is the widely perceived attitude that short selling causes significant market declines and even stock market crashes. The Bible has a lot to say about falsification. Exodus 23:1 says, "Do not spread false reports. Do not help a guilty person by being a malicious witness." Thank you for listening, and God bless.